Hey, welcome everyone to the City Different second quarter outlook call. Thanks for spending a little bit of time with us. We'll try to be brief. Our colleague Michelle, our head of distribution, is working with a client, so isn't able to be on the call. In that optimized high level of service we want to be known for here at City Different. So you're stuck with me, Connor, CEO. On the call, we've got Chris and Shweta, who co-lead investment grade fixed income efforts, Joel Van Essen, who leads our small business practice, Lim, who supports equity work, and he'll be speaking on behalf of our global strategies. Rolf, who joined this year, portfolio manager focused on international and global markets, and Ronald, who leads our efforts with me. So as we go, feel free to ask questions in the Zoom terminal, and we will get right to it. Let's start with a taste of the macro. Chris, Shweta, what are you guys watching most closely right now?
Well, through most of the quarter, we've been watching the yo-yo conflict with Iran. Depending on the day, you get a different read on when the conflicts could cease, and that's causing oil prices to yo-yo, and that's causing higher expectations for inflation, and they are kind of coming through as the numbers progress. We also have a new Fed chief, Kevin Warsh, who has spoken quite hawkishly about inflation being a choice, and wanting to have family fights in the discussions. Well, he has been talking tough, but it hasn't followed through. And he has 5 different task forces, so they're going to re-examine the foundations of the way the Fed looks at markets. But what this has done is to create a higher degree of uncertainty with market participants. And that uncertainty translates into a higher risk premium for owning bonds. And what we think will happen is that risk premium will play out in a steeper yield curve. Right now, the yield curve is very flat. Treasuries are running 2s, 10s about 50 basis points. That typical spread's about 100 basis points. So there's still a lot of room there. In the municipal market, 2s, 10s are running about 70 basis points right now. And that long-term average is about 140 basis points. So again, that has a long way to go. We've been focusing on the shorter ends of our strategies investment universes because in our estimation, we're getting paid to wait. If you look at the ratio of a 5-year treasury yield versus a 10-year treasury yield, you're getting about, excuse me, let me get this right. You're getting about 93% of a 10-year yield by buying a 5-year yield. That long-term average runs around 77%. In the muni market, you're getting 87% of a 10-year by buying a 5-year. So we think we're getting paid to wait. So we're going to maintain our overweight to the front end of the yield curve in our strategies, and also we're going to keep our durations neutral at this point in time until we get a clearer view of what the new Fed chief and risk premiums, how they fall out. Shweta has an interesting piece on why bonds are important in a diversified portfolio. So rather than me ramble on, I'll give it to her with some more interesting data.
Thanks, Chris, and thank you everyone for being here today. I wanted to talk about the stock-bond correlation that has flipped negative for the 4th time in 2 decades. And each prior flipped lined up to a curve steepening episode, like Chris is referring to, which is what we're anticipating. And the curve steepening has really preceded a real economic inflection point. So we don't think this is a coincidence. A negative correlation means that the market is really pricing supply shock as the dominant risk and not demand shock. We saw housing overheat, remember, in 2006 and 2007, And similarly, in 2026, this is an AI capex and Iran war story that did the job in 2026. So in each case, yields rose even as growth slowed. And that's the signature of a supply constrained economy rather than a demand driven one. And we can see this pattern fit price action in the treasury market, for example, this week. The treasury yield has come down a smidge, but we saw 2-year treasury yield break 4.3%. And then there was the 10-year auction that tailed at 4.7%. So that's the highest since 2007, which is a meaningful year. And none of it moved much, even after a softer CPI. So our conclusion is that, yep, you saw cooler inflation. To Chris's point, yo-yoing of the Iran war, think about oil prices and how oil prices percolate into inflation. So sure, you saw cool inflation prints in terms of CPI, and it used to mean in this old regime a lower yield. And now it's barely registering in the market. So that's telling you a market that is nervous about inflation. And for us, this argues against betting on a quick return to that old demand-driven regime where you get soft data and yields come down instantly. To me, I saw this 25 billion 30-year sale pricing at the highest cost for the Treasury since 2001. That confirms that the investors want more term premium to hold longer paper in a supply constrained world where real yield, energy shocks, tariff, AI driven capex all are competing for the same capital. So to reiterate what Chris is saying for the fixed income team, for our part, this means we are midpoint neutral in all of our strategies. We are anticipating a steeper yield curve, and the new Fed regime is adding to volatility. So be prepared for a more volatile fixed income market. Now, don't necessarily be nervous about it, because as active managers, a volatile fixed income market gives you opportunities to invest and rewards you on the right bets. And also this correlation piece is a big piece where stocks and bonds are now negatively correlated, which means stocks go up, bonds go down, bonds go up, stocks go down, which is a nice piece. That is what you want your bond piece to do. It's a diversifier, a ballast in your portfolio. So let the AI and the equity story play out and still be diversified. Thank you. That's all from the fixed income team.
That was great. Thank you, guys. The team knows their stuff. If you're worried about any of this uncertainty, it can help. Please reach out. Okay, let's transition to the equity markets. Rolf, you recently wrote a paper looking at the AI cycle. There's a lot going on in that space. What do you think investors are getting wrong today?
Yes, so thanks, Connor. I went down a rabbit hole trying to answer that question, are we in a bubble or not? Because I started investing in the .com time period and lived through that fun bubble. And there were things that reminded me of that time period. So that's what really triggered this. And I thought about it just to go at it from a supply and demand aspect. So I'd make 5 or 6 points here of what I found in that rabbit hole. So we have no idea what true demand is. One of the fun experiments in the paper is go to your closest AI chatbot and ask it what it needs to charge you in order to make a profit. And I did that experiment, and it was 10 times what I'm currently paying. So as we know, the labs or the AI model providers are selling tokens way below cost. So there's a huge subsidy in there for demand. And one way to think about that, if I sell any good, and we used a car, if I make a $100,000 car and I sell it for 10 grand, everybody in the country that can drive a car is going to be lined up to purchase my vehicle. But it really tells us nothing about what the true demand and value is of the product and service. That's a huge fundamental problem. what I also found was demand is simply going to take time. The real world is messy. And I love to look back 10 years when everyone was saying, okay, autonomous vehicles are here and no one's going to have to drive a car in the next year or two. And here we are 10 years later, and it's still slowly trickling out. I think the same thing is happening on the corporate side with the system integrators that I talk to. So these are people like that work at Accenture that help companies integrate AI to improve their business process. And it's just messy. People have to be retrained. They have processes that have been established over decades. There's special use cases. There's budgets to deal with. There's liabilities to deal with. You can't have hallucinations in certain industries, like healthcare, for example. Imagine, a hallucination in healthcare. That could be really nasty. So it's just going to take time for demand to really get established, and it's not growing at the same pace as supply. There's been a massive commitment to supply from hyperscalers, neo clouds, and the likes. And the build out has already surpassed on a CapEx basis the dot-com bubble. And it's on track next year to be 2.5 to 3 times what that capital build out was in 2000. So this is the largest capital build out of our lifetimes. And right now, there's an uncertainty on demand. And the next point I'd make, there's an uncertainty on what sort of returns we're going to make on this build out. Because at the model or application layer, not the picks and shovels, because you need to see at the models or applications where the return is coming on this investment. And right now, those models are not making profits. In fact, they're heavily loss making. And right now, they're not going to be able to make a profit or a sizable profit with the switching costs as low as they are. I have already personally switched my favorite model 4 to 5 times. And there are companies called router companies that are allowing corporations now to switch models pretty easily and rapidly. So there's developing a case where there's not going to be very high switching costs at the corporate level too. So that's a huge problem. And one thing we look for when analyzing businesses is you need a moat in order to be able to charge a price that sticks and make a profit. I'd warn people to be cautious on the picks and shovels players, like the memory providers, like a Micron, for example. We're at record margin and profit levels because of the pace of this build out. And don't forget, semiconductors is a very cyclical industry, and never forget that rule. And typically, I've been following this industry for 15 plus years. You buy these companies when they're not making any profits, which, by the way, 3 years ago, they weren't making any profits. So this is, again, a highly cyclical industry, and I warrant caution. Don't just look at a cheap multiple and say, buy. And then the last thing that I came across, which was very concerning, is the level of speculation going on today across various markets. IPOs coming out of certain companies, cryptocurrencies, single stock levered ETFs being launched, not just in the US, but around the world. So there's a lot of speculative activity going on that reminds me of sort of dot-com time period. And right now, the best measure I have is margin debt, which is what investors are borrowing to buy stocks, basically. And that margin debt has crossed 6%. It's at a record level and has surpassed the level it hit in 2000, 2007, and 2021. And I don't need to remind people what happened subsequent to those spikes. And if you want to see it in chart form, that's the most, a picture is 1,000 words. Go into the paper and look for that chart because it's very powerful. So my conclusion is, yes, we are in a bubble. I don't know when it'll burst or how long it'll take, but there's also lots of interesting, boring, unglamorous businesses being left behind at good prices. And that's where we're going looking and buying for our shareholders.
Awesome. Thank you, Rolf. So you're suggesting the semiconductor space, Rolf, it's not different this time?
That is correct. It is not different this time, is my take.
We hear all the time on the ups of a cycle.
Super
Okay,
cycle, right?
it's different this time. Don't worry. Okay, thank you, Rolf. Um, and we'll mention again at the end that that's available on our website. But there's room for disagreement here at City Different, and I've argued some of the positive case, and especially hard to call the timing on a bubble, Rolf Kelly. Things can go up a lot more for much longer than you'd ever imagine. So we have a lot of that internal debate. Zhang is joining us today from China. What time is it there, Zhang?
It's 2:17 in the morning.
You look fresh. You look ready. Good. Okay.
Yeah.
Give us your take on your travels in China. I think you've especially got some views on AI in China.
Yeah. Thanks, Connor. So I've been traveling in China, like some of you know. And as always, I'm observing as much as I can, especially about investing, what trends we should be looking at for investing, and trying to make that comparison between what we see in the US and in China. And it's interesting. So when it comes to trends, I think the electrification trend, that's what we are quite bullish on from the global side of things. And the AI theme, of course. And the AI comparison is very interesting. So I don't know, like maybe what Rolf is subtly suggesting, like when I read about what's happening in the US, especially the past summer, I mean, there's obviously a ton of excitement about which memory stocks went up 10 times. But I think among the regular folks, like it's about white collar jobs getting killed, AI escaping and hacking each other, AI making young folks not think. So very not cool things, I think, is what the Westerners or what Americans are focused on. And despite we know AI making us very productive, and that is very real, and that is, I think, Connor Brown's perspective. I'm not saying this to make him happy. I see it in my own work. I use AI every day now, and I didn't use it to script what I'm saying today, but it is making me productive, and it's real, especially in an environment where I think half of us are doing white collar work. It's useful. And on the ground in China, the feelings are very different. I think there's more excitement. It's real. If you talk to a regular person, they can get into discussions about how AI is actually creating micro dramas, which are actually 1 to 2 minute per episode TV shows. And they do it at so low cost and getting higher quality every single day. They basically produce 4 or 5 shows a day, and they create a ton of them. Hopefully 1 or 2 would get like pretty hot. And even the scripts are done by AI, and the filming is done by AI, obviously, and it's getting pretty good. And tens, if not hundreds of millions of people watch it. So it's interesting. And then the hottest gifts for kids are AI-enabled animal stuffies that kids can just ask about the origins of dinosaurs. Like my 5-year-old just got one. So I think the comparison is interesting. I don't know if it's a bubble or not. There's just more excitement, more adoption of AI in China. And frankly, same thing for EVs, right? It costs $6-7 to charge for 300 miles. And the Chinese don't have the baggage of hanging on to their gas guzzling SUVs. They just go for what's cheaper and what's greener. And all of these are, just to remind myself, are powered by the rapid build out of electricity, of renewables that they've done over the past 10-15 years. Like electricity just cheaper, more abundant here. And if we remind ourselves, that's what's powering AI and EVs. So, and it's interesting, even comparing the heat wave situation, you read about Europeans not wanting to use ACs. I think Americans, we love ACs. Like the Chinese being lower income, they love ACs as well. It makes you more comfortable, more productive, and to survive. So we need electricity, and even though we don't know the true supply demand situation of AI, like I think the electrification need is real, and obviously this has some implication for global investments. And I've written a blog about this, and I hope you all will read it. So I'll pass it back to Connor.
Thanks, John. One super quick follow-up, be brief. What do you think the difference is in a positive view of AI in China and a really negative view in the US?
I think there's a sense of you have to move quick here in China. There are a lot more people here. The there's less resources here. If you don't pick it up, you're going to be left behind. And I think in America, things are more abundant. We can take it slower. Not so for the Chinese. So they are more excited naturally. They naturally like to hinge on the newer trend, but perhaps they have no choice as well because it is making them more productive. So maybe we can take it slower in the US, but let's not let the Chinese overtake us.
It could also be vested interest in the US, right? Like we have a lot of big oil companies, for example, with powerful lobbying efforts and government and manipulation in the population. And China's got nothing to lose, right? They benefit from a change in technology because they can capture, say, autos and electric vehicles where they're now pretty much leading the world. And the established players like US and European auto companies are trying not to move so quickly so they don't kill their profit engines.
Okay, let's transition to domestic. Rob, I think both, well, especially Rolf mentioned there are areas that are being overlooked. What are some of those areas you're doing work on in the US?
Yeah. Yeah, in the US market, topics of conversation are AI. Like that's, just like our previous two speakers, that's the topic, and then energy. In the AI world, it's how much are these companies going to spend, and then how does it change? Like who gets disrupted, who doesn't? They both mentioned a lot about AI, but the one thing I was thinking about was these hyperscalers are spending tons of money, and it's sort of the question is usually will they earn a lot and have great returns from this? And then there's also the case to think about where they need to do it, meaning that there's a new technology entering and they have to spend just to keep up. So there is a case where hyperscalers could feel some pressure too, and so they could lose and other players could win. But just thinking about how what's changing with AI, this year there's been I think there was sort of let's sell everything that we think is going to get impacted by AI. And then I think more lately there's been more nuanced views of like maybe not all software is bad. Maybe there'll be some software that will be okay or even benefit from AI. And so I'd say on the margin, we've been buying a little bit of software. We've been buying a little bit of alternative managers that have exposure to credit to software. So those are some areas where we think there's been excess pessimism and disruption fears. And then in general, I think energy is really interesting. The Strait of Hormuz closing, maybe the Red Sea, and then just thinking in general, where are the bottlenecks around the world and who with very cheap technology can cause some disruption. And so that we sort of need to think about that. I think one area is offshore oil and gas. I know Global has a big investment there. Domestically, we do. But it seems that there's a lot of countries going to be uncertain about their supply, and I could see there being a bit more spending going forward. So we've been on the margin adding a little bit in that area as well.
Thank you, Rob. Appreciate it. Let's get to Joel Van Essen, who I think recently reviewed the Stanford Search Fund study. What stood out? What stood out there, Joel?
Yeah, that's right. Unfortunately, I'm not speaking about anything AI related in the small business world, and I'm going off topic here for today's webinar. But yeah, Stanford publishes a study twice a year on search funds, which, if you're unfamiliar, is when entrepreneurs, often right out of an MBA program, raise capital to buy a business. And this is interesting for us to follow because the types of businesses they're acquiring are very similar to what we're looking for in our small business acquisition strategy. This year was the largest cohort of search funds that they've ever had. So they reviewed 862 search funds. This philosophy or this strategy for post MBAs and entrepreneurs continues to grow. More and more people are looking to go kind of a non-traditional path from the typical investment banking or consulting and acquire a business on their own. I think part of this growth is exacerbated by the headlines about how, raising a search fund is your easiest path to making millions of dollars. And there was an article shortly after the Stanford study was published in the Wall Street Journal called "The Shortcut to Private Equity Riches in Minting Young Millionaires." So more and more people are pursuing this path. But I think an interesting tidbit from the study was that the success rate of actually acquiring a business has fallen pretty dramatically from 58% to 48%. I think there's some selection bias there with who's actually reporting to this study, and so I imagine it's quite a bit less. And so even though the headlines say, this is a really viable path, and I think for some it certainly is. It's becoming increasingly hard to find a business and to actually acquire one if you're going out and doing this on your own. The last interesting piece I wanted to pull out of this study was they introduced a new term for the first time called long duration enterprises, which is essentially a search fund that has a longer time horizon than a typical 5 to 7 year exit. They're defining it as a 10+ year hold period. I think we've seen this in the bigger PE space as well as the smaller business acquisition space, that acquirers are having a harder time achieving their investment returns in that shorter time horizon. That's why you've seen this growth in continuation vehicles in the mega PE world. This kind of long duration mindset is something that we've always held at City Different Investments. We underwrite all of our deals with a long-term, if not indefinite, hold period where we think we can be better stewards of the business for the long term. So just a few interesting tidbits that I pulled out of that Stanford study.
Thanks, Joel. I think there's a real conflict when you're trying to dress a business up to flip it in 5 to 7 years versus building real long-term value. And I think you're right. PE generally has had a hard time exiting last couple of years. And then what have they done that maximized for 5 to 7 years that's actually going to hurt a bit in 8 to 10? Okay. We got a quick minute for a question, and then we'll wrap this up and get everybody on their way. I'll go with the non-AI one. Hey, Chris, Shweta, or Rob or anyone else on the team, any views on what's going on in the private credit markets? I know that's taken a lot of attention away from plain vanilla, boring investment grade fixed income, but maybe we're having a moment of a comeback here. Any thoughts?
The headlines, especially this week in the Wall Street Journal, have not been too positive about private credit and private equity. Although the purveyors of those funds tell us nothing's wrong, but you can see dividends being cut and default rates increasing. So I don't know. I have a personal bias against private equity and private credit. I don't like anything that's being valued based on a consultant or a black box. I like the fact that there are two-way markets. There's a buyer and a seller, and that's how you have true price discovery.
Quick 10 seconds take on it is, remember February, that was a pretty prominent event that played out in the market. And for us, we usually see the proverbial canary in the coal mine in the high yield market. And because this is happening in the private market, this is, to quote Rolf, this time it's different, but this time it is different. In the fixed income public markets, we can't see much of what is going on in the private space. Now, one interesting data point that we saw with New York State Tax Division reporting, the bonuses on Wall Street on the public side for public equity, public fixed income were at all-time record high, and private credit and private equity compensations was much lower, suggesting the performance and the panic and the gate, the guardrails and the gatekeeping, right? The proof, if the proof is in the pudding, it's in the comp of how the players are paid, that certainly is not a good omen for the private market.
Rob, go ahead.
Yeah, I think a lot of news flow and headlines has been related to evergreen funds, and a lot of high net worth and maybe smaller institutions were allocated there. I get concerned about private credit, especially for software, and then a lot of people trying to exit semi-liquid vehicles and that's created some issues. It seems like that's calmed down a bit, but it's, yeah, there will be losses and people will get hurt. But I think, I kind of think private equity goes through cycles, and there's, depends on when you originated a deal. It has a lot to say about, what the returns for that generation does.
Okay, great. We're a minute or two over time. Sarah, want to wrap us up here?
Sure. I just want to thank everyone for being on today and just remind everyone that you can see more of these great insights from our team, especially about some of these AI topics in John's blog that is about to be released, Postcard from Chengdu. We've got Connor's AI video, Is AI a Bubble? And we also have Rolf's piece, Pulling in the Sales. So please check all of those out, along with the rest of our insights on our website. Thank you all.
Thank you, everyone.